like most financial advisors, one of the most common and important questions we get asked is, I've saved up a certain amount of money, and can I retire now? And if I do, what does that look like? Or can I retire in 2 years, and what does that look like? So in today's video, I'm going to use a free online tool so that you can follow along to go through this scenario. It's somebody that's 58 years old. They've saved $700,000, and their question to me is, can I retire, and how much money can I spend without having to worry about running out of money during my lifetime? And stay to the end, I'll share with you what this free online tool is so that you can go back and change the numbers for your specific situation. Okay, let's jump in. So the first thing we have to do is enter some personal information. First thing is the name. I just use the scenario name 700K at 58 years old. And then Social Security. What is Social Security going to be, and at what age? So I'm assuming this person's going to take Social Security early at age 62. So that's $2,000 a month. We'll come back later and we'll look at 67. We may look at 70. And at 67, if you're getting $2,000 a month at 62, you would get 70% of your full retirement benefit. So that would be the full retirement benefit would be about $2,900. So I've got $2,000 a month in at age 62. The rest of this is all default. You can see that's growing at 2% roughly inflation. Again, stay to the end. I'll give you the tool, but I want you to first get a feel for how to use this tool. The next thing we have to enter is the portfolio. This person has $700,000. I'm making up an allocation of 60% stocks, 40% bonds. I'm not recommending that. None of this is financial advice. I'm just walking you through this tool. You can change that to 100% stocks if you want. And you can change that to 0%. But that's the asset allocation. Next thing we need to look at is expenses. I've got that at $2,500 a month. At 2%, we're going to do a Monte Carlo simulation on this and see, what's the likelihood that spending $2,500 a month, which isn't much, it's $30,000 a year, will survive this person's lifetime. So let's look at this. First, we have to look at expected returns. Again, this is the default for this free tool. The stocks they have at 8%, the bonds they have at 4.5%, including fat tails. That just means that stocks tend to either have years where they're doing well, or they have years where they're not doing well. So if you remember the Bell chart from high school, it doesn't quite go down away from the median, doesn't quite hug that lower axis. It has returns that are higher than what a normal distribution would dictate. Okay, so what do the results show us? The results are great. In this case, this person never runs out of money. I should share what we're looking at. So this free tool uses a Monte Carlo simulation, which is trying to simulate. If you look here above, just below simulation, it says we ran 10,000 simulations. So each of us lives our own one unique life, but they take actual stock market returns, they randomize those, and they give you 10,000 fictional lives with various investment returns. So the top of this light blue chart, that's where people got lucky and they got good returns. That's the upper 20% of positive returns. And then the lower part of this light blue area, those are the people that were unlucky. So same scenario, same asset allocation. People end up with about $1 million to a little over $4 million, depending on how the stock market did, what the sequence of returns were. Did you get good returns early on or a poor return? So top of the graph is lucky, bottom of the light blue is unlucky. You can see even in the unlucky scenario, the person's passing away with almost $1 million. That dark blue line is the median. Half of those 10,000 cases did better. Half of those 10,000 cases did worse. And the median case here is the person's passing away with over $2 million. So that's a good situation, right? Okay, so we don't want to leave that much money on the table. So maybe instead of spending $2,500 a month, what happens if all we do is we change the expenses to $3,000 a month? We leave everything else the same. So we run that scenario again, and again, we're not running out of money, but now the unlucky people are passing away with about $250,000. You can see here at the bottom, the 20th percentile probability is it's $220,000. The median is $1.25 million. And the lucky people are passing away with over $3 million at the age of 90. It's assuming a life expectancy of 90. So let's see, maybe we increase it to $3,500. Let's see what happens there. So again, the only thing I'm changing is expenses. Instead of $3,000 a month, let's see what $3,500 a month looks like. Okay, now this is one that we have to look at, right? Because the unlucky people aren't making it until 90 until they run out of money. So they're making it to about 83 until they run out of money. The median person has almost $500,000, half the cases and more. People are passing away with about $500,000 or more, but we need to look at this 83. So the previous cases probably had a probability of success like 99%, right? Because people were passing away with money, maybe even 100% probability of success. Where here, this is probably closer to like an 80% probability of success, maybe a little bit lower than that. So again, in over half of the cases, people have $500,000 or more. So I do have clients that would say, yeah, let's spend that $3,500 and I'll adjust if I need to. If I find out that I'm unlucky and I'm in the lower half of these cases, we'll make some adjustments. But I'd much rather spend $3,500 a month than $3,000 a month. And certainly I'd rather spend $3,500 a month instead of $2,500 a month. So, but what do we do about this passing away at 83? That's, again, for some people, they'd say, you know what, if you look at it, this person's 58 years old, right? So they have over a 50% chance of being able to spend $3,500 a month. So there's a couple things they could do. They could throttle back and only spend $3,000 a month and take that risk away. Or they could say, I want to spend the $3,500 a month. I'll see how things go and I'll adjust later on. Another way to look at this is to go from, let's say you really want to spend $3,500 a month, to go from, let's call this an 80% probability of success, to go from an 80% probability of success to a 95 or 97% probability of success for most people means working an additional 3, 5, maybe even 7 years, right? That's 5 or 7 more years that your retirement accounts don't have to support your living. And it's also 3, 5, 7 years that you can continue to add to your savings. But that's 3, 5, or 7 years that you're guaranteed you're going to have to give up in retirement. And at 58, 58, 59, 60, those are your youngest, strongest mental acuity, highest energy level. This is the youth of your senior years. So if you choose to work another 5 or 7 years, you've guaranteed giving up, you have 100% likelihood of giving up that extra 5 or 7 years that you could have been retired. Or would you rather take the risk of 80% chance that you have to throttle back? And none of this is financial advice. That's a personal decision. But let's look at this. Let's take the Social Security. Instead of getting it at 62, let's take it at 67. So again, the unlucky people are running out of money at 83. Let's see what happens if we take Social Security. We wait, we get a higher Social Security check. Instead of taking it at 62, we'll take it at 67. So I'm leaving the expenses at $3,500 a month. I'm taking my Social Security to $2,860. If you take that number times 0.7, you would get that $2,000 a month, which you would get at 62. So this is at age 67, as you can see here. And if I run it, the unlucky people actually start running out of money at age 82, a little before 82 instead of 83. So things are actually worse, so we don't want to do that. Okay, what if instead here in this situation, we wait till we're 62 to retire and we save instead of retiring at 58, so taking Social Security at 67 instead of 62 didn't help. What if instead of retiring at 58, we retire at 62? We save 10% a year during that time, but now we get to increase our spending to 45. So we give up 4 years of retirement in order to be able to spend $1,000 more a month for the rest of our lives. So instead of retiring at 58, this 700K at 58 scenario here should read 700K at 62. And they have an annual income. Here they're not retired, and they're going to retire at the age of 62. They've got an annual income, I just assumed $65,000. Their Social Security is going to be $2,000 starting at age 65. And the expenses here, we increased to $4,500. And here you can see, instead of running out of money at 83, the unlucky people run out of money at a little over 84. So the question is it worth working 4 more years in order to decrease your chance of running out of money, instead of, in the unlucky case, at 83, increasing that to 84? Again, that's an individual decision. But I do want to share one more scenario, which is, what if you're a couple? There's 2 of you. So you're 58. Let's say your spouse is 58. Now, maybe we get 2 Social Security. We do get 2 Social Security checks. And let's assume one person is getting that $2,000 a month at age 62, and the other person is getting $1,000, 50% of that $2,000. So now we have $3,000 a month coming in at age 62. I am saying this couple is retiring at 58. They also have 700K. So the only thing here is they have more money coming in from Social Security. It's $3,000. And first, I'm going to run it with $4,000 a month of expenses instead of $3,500. What does that scenario look like? And in this scenario, they can spend $4,000 a month. The median person passes away at 90 years old with a little over $500,000. You can see here, though, there's still a likelihood the unlucky people are going to run out of money at about 84 years old. So again, I wanted to share this kind of the thought process. It's an iteration process. You don't want to use a free online tool to make the decision whether to retire or not. I think it's great to get you in the ballpark, but I think for your final decision, you do want to speak with a fee-only financial advisor, somebody that's a fiduciary to you 100% of the time. And with that disclaimer out there, the free tool is honestmath.com. I'm not sponsored by them. I just think it's a powerful tool. I like the Monte Carlo simulation. I like the high-level ability to change numbers around. I like the fact that you can work with this at home and get some numbers yourself. Again, see a professional to help you with it. If you enjoy this type of video, I know you're going to enjoy this video up here, which talks about boomers. The average boomer is in trouble. They don't have enough saved for retirement. So boomers are in trouble. I'll see you in that video. Thanks for watching this one.